Good day. In this video, we will take a look at the examples of the capital gains tax principles discussed in the previous two videos. For this first example, we have the following information provided in this scenario. Gregory is married in community of property to Michelle, and they own their home, which falls within their joint estate. The house was originally purchased 5 years ago for $900,000. Since acquisition of the house, the flatlet, which consisted of 10% of the house area, was let out. They sold the house to move into a bigger one during the current year of assessment for $2,100,000. Gregory also sold a boat he used for leisure, which fell out of the joint estate during the current year of assessment. He received net proceeds of $570,000 after 5% administration costs. Gregory purchased the 12-meter boat 10 years ago for $368,400. Michelle had no other disposals during the current year of assessment, but had an assessed capital loss of $12,000 from the prior year of assessment. We are required to calculate the taxable capital gain for Michelle and Gregory. Remember, terminology is very important for this topic. If you're required to calculate the taxable capital gain, then it means you need to provide the net capital gain multiplied by the inclusion rate, which is 40% for natural persons and special trusts. Going back to what is required, you need to analyze your information carefully. From the information provided in the scenario, the following items should have stood out. Firstly, Michelle and Gregory are married in community of property, and the house they are disposing forms part of their joint estate. This means that they will be deemed to have disposed of the house equally. Secondly, 10% of the house was let out, which means there was trade use. So an apportionment needs to be made. Thirdly, Gregory received net proceeds after a 5% administration cost was deducted. This needs to be carefully considered when determining the proceeds. Fourthly, Gregory disposed of a boat with a length exceeding 10 meters. This means that even though this asset is used for leisure purposes, the capital gain will not be disregarded as it is a personal use asset. However, if Gregory makes a capital loss on the disposal of this asset, then the capital loss will have to be disregarded. Lastly, Michelle has an assessed capital loss from the prior year of assessment. Now let us look at the suggested solution for Michelle. As she only had one disposal, being the house, her taxable capital gain will be determined as follows. The proceeds, as mentioned in the scenario, is $2,100,000 less the base cost of $900,000. That will amount to a capital gain of $1,200,000 in total for the house. $10% of the house was used for trade and not domestic purposes, and therefore only 90% of the capital gain will be subject to the primary residence exclusion, resulting in a capital gain of $120,000. So, if you were required to determine what portion of the gain would be subject to the primary residence exclusion, then that would be the $1,080,000. As the house forms part of the joint estate, only 50% of the capital gain will be included in Michelle's capital gains calculation. The other 50% of the gain will be included in Gregory's capital gains calculation. Michelle only had one disposal, and therefore the capital gain of 60,000 will also constitute the sum of the capital gains. The next step would be to reduce the capital gain or the capital loss by the annual exclusion, which is currently 40,000. Remember, if Michelle had a capital loss, then that capital loss would be reduced by the annual exclusion of 40,000. Since Michelle has a capital gain, then the capital gain of 60,000 will be reduced by 40,000, that is the annual exclusion, to get to the aggregate capital gain of 20,000. One of the key items noted in this scenario was that Michelle had an assessed capital loss carried forward from the prior year of assessment. Therefore, the aggregate capital gain of 20,000 will be reduced by the assessed capital loss of 12,000, resulting in a net capital gain of 8,000. Finally, the net capital gain will be multiplied by the inclusion rate, which is 40% for natural persons as well as special trusts. If we think back to the steps for calculating the taxable capital gain and apply them to this example, then those would be as follows. Step 1, determine the sum of capital gains and losses. In this case, we have a capital gain of 60,000. Step 2, to determine the aggregate capital gain, and that is the sum of the capital gain reduced by the annual exclusion for this example. Step 3 is to determine the net capital gain, that is the aggregate capital gain reduced by the assessed capital loss. Step 4 is to calculate the taxable capital gain by multiplying the net capital gain with 40% and having that final result of 30,200. Gregory has disposed more than one asset, and our first step in this scenario would be to determine the capital gain or loss for each of the two assets disposed separately. Gregory disposed of the house as well as the boat. The capital gain for the house is exactly how we calculated it for Michelle, and that would be that 60,000. So the other 50% of the gain that we calculated for Michelle. The boat was disposed for proceeds of 600,000, which is the net proceeds of 570,000 divided by 95%. The reason why we divided by the 95% is because the 5% related to administration costs, so we need to get the 570,000 to be an amount which is gross, or which is a gross amount. So for us to do that, we will need to divide this 570 by 95%. If we refer back to the previous videos that we did, remember we said the proceeds is the gross amount, so it's the selling amount, right? So this person sold this boat for 600,000 and not for 570,000. Although they received 570,000, their selling price was the 600,000. So what will we do with the 5% administration costs? We will need to consider that by including it in the base cost, or in the base cost and adding it to the acquisition cost of 368,000, and then getting to the final base cost figure of 398,400. This capital gain, as I mentioned earlier, will not be disregarded as the boat is not a personal use asset due to its length. The sum of the capital gains then is the 60,000 from the disposal of the house, as well as the 201,600 from the disposal of the boat. The aggregate capital gain is 221,600, which is the sum of the capital gains less the annual exclusion of 40,000. Take note that each of the spouses have the full annual exclusion. So this is not split between the spouses because they disposed of a joint asset. That is not the case. So each of the spouses will have an annual exclusion, or the full annual exclusion of 40,000. Finally, the taxable capital gain is the net capital gain multiplied by the inclusion rate. And that will give us the amount, or the final figure, of 88,640,000 as Gregory's taxable capital gain. Now, if we apply the same steps that we applied to Michelle in order to calculate the taxable capital gain, the first step would be to calculate the sum of the capital gains. The second step would be to calculate the aggregate capital gain. The third step would be to calculate the net capital gain. And then finally, you would need to calculate the taxable capital gain. This brings me to the end of the capital gains tax video series. Thank you.